Index funds versus property investment. If you are looking to invest either in properties or index funds and you're not sure which one to start with, this video is for you. Here is what you're going to learn in this video. We're going to discuss the definition of property, the definition of index funds, how and where you could invest in index funds, as well as how you could invest and where you could invest in property to give you equivalent return on investment. We're going to look at the historic return on property versus index funds, as well as going to look at the returns and calculations on index funds versus property investment. And at the end, we're going to bring it together and discuss the advantages and disadvantages and what my personal opinion is if you were to choose to invest in one of these strategies. What I'm about to share with you is my knowledge I've implemented to be able to build businesses from nothing to multi-million businesses. So if you cannot invest 5, 10, 15 minutes of your time to learn how I use my knowledge to become successful, I'm afraid you're not going to make it. Before I started my entrepreneurial journey, I had various options I was looking at because I was trying to find my why and what sort of investment strategy do I need to execute in order to get me to financial freedom, to be able to get my calendar back so I can spend time with my loved ones. The first investment strategy I bumped into was crypto. It was amazing. It was showing lots of return on investment, but it was a lot more riskier than any other investment strategies that I was looking at out there. And then I bumped into Forex. Forex was one of the ones that really resonate with me. I may not have the thorough knowledge to make money in it, but I see it also as if I was gambling my money away. So I also looked into online businesses, i.e. buying product from China, Bangladesh, Asia, and then get those products shipped here in the UK and sell it for profit. It was an amazing idea. It was really beautiful. And I know it would get me profit as well, but it wasn't actually something that I see myself doing because it involves me doing work. If I don't do anything, in most cases, I may not be able to get money. And obviously I'll have to go through sourcing materials, looking for suppliers and returns, dealing all that sort of thing. So it was a bit overwhelming for me. This then leaves me with two strategies: index funds or property investment. So I like the idea of index funds. But before we get to talk about index fund, what is index funds? An index fund, also known as tracker fund, is a type of investment fund that tracks the performance of a specific index, such as the FTSE 100, FTSE 250, or S&P 500. When you invest in an index fund, you gain access to shares in a variety of companies at once, usually for a relative low cost. So in essence, you're going to put your money in a pot of fund that tracks the 100 best performing companies in a country. It could be the FTSE 100, it could be the FTSE 250, it could be the S&P 500 or the DAX. So, property. What is property investment? Property investment is the process by which an investor would purchase a property with the intention to rent it for additional recurring income. So, what is the historic return of index funds? In the past 80 to 90 years, index funds have seen an average of 10 to 15% return on any investment put into the index fund. So, taking inflation into account, you're talking about 8 to 7% annual return for the past 80 years. So how do you invest in index funds? There are various applications out there. We have Trading 212, Hargreaves Lansdown, eToro. So you can go into these apps, register yourself, get your identifications approved, and then you can then invest in various ways. You could either invest using an ISA, which is the most tax efficient way. You're able to put in up to £25,000 without getting any tax on it. And then you use that money then to invest in index funds. Suppose we are going to invest in index funds. That index funds, we're not going to go for the 10% or 12% annual return on investment in it. But what we're going to do is that we are going to take 7%, which is the reserve figure, taking out all inflation from the calculation. So there's a simple website calculator here, compound interest calculator, which would calculate how much you're likely to make if you were to invest in an index fund. And investing in an index fund works this way. You're going to put a principal amount. That is the initial investment you're going to be putting in. And then obviously looking at how much you will be contributing every single month in order to increase your investment. And that way, then they'll use that money to invest for a better return on investment. Let's say we had an initial £5,000. So that would be our initial £5,000, and our contribution would be £350 every single month. And here's the deal. Most people will be able to afford this if they set their mind into it, because if you're working, you should be able to squeeze in £350 every single month in order to make you financially free by the age of 40, 50. Okay, so then we've got that, and the length of time would be 20 years. And we want to be reserved here. We're not going to go for 10% because obviously we want to take inflation into consideration, as well as looking at the worst case scenario. Suppose you got a return of only 7% for the next 20 years. By the way, this is very realistic, as the index funds tend to perform between 10 to 12% every year in average over the past 80 years. So if we invest £5,000 initial investment and £350 every single month from now, in 20 years for only 7% return on our investment. So if we calculate that, that would give us £191,529.49. So that would be the return we would have gained from investing in an index fund. So that is your return there, which is the £191,529.49. And then obviously this is the money we would have put in there. We would have put in £89,000 in this investment. So that £89,000 would have more than doubled in the next 20 years. So it's a very good investment. But before we come to conclusion on which one to choose or what are the advantages and disadvantages, let's look at property for a minute. So what is property investment? Property investment is a process by which an investor will buy a property for the intention to rent the property out to make passive recurring income, not to live in. By the way, I'm talking about investment properties here. So in average, property prices has gone up between 10 to 15% in the past 80 years as well. So in essence, property also is doing really, really well, and it is a good investment strategy. And also the beauty of investment property is that you'll be able to buy that property and then you'll be able to rent it out. You make that passive recurring income, which I'll be talking to you about a lot more towards the end of this video. So let's look at it this way now. We have looked at the calculations for investing in index fund. It's not bad. It's a very good return. To make £191,529 is a very good investment. So let's look at property. Suppose then we want to invest in property. So we already know we would have put down £89,000 to make that £191,000 on the index funds. So if you want to buy a property, one of the beauties of investing in properties is that if you want to buy properties that were, for example, £100,000, you don't need £100,000 in order to buy that investment property. You'd only need 25% of the amount you're buying that property, and the bank will lend you the 75% to buy that property. So let's take an example. And with that £89,000, we're going to go and look for properties that are below £89,000. We're looking for properties that are worth about £100,000, so that then the bank will lend us the 75% to buy that property. So if we were to go and look for that, we're going to go look for a property worth, let's say £100,000. So out of that £100,000, the bank will lend us 75% of it, which is £75,000, and we will put down a deposit. We will put down a deposit of £25,000, let's say, plus legal costs and stamp duty. Let's say that would cost us about £30,000. Maybe we've bought the property, we need to paint and decorate it, set it up really nice, maybe do a little bit of refurbishment. Let's say that then cost us about £14,500. So that then gives us an initial investment of £44,500 for one investment properties. But because we've got £89,000, we're able to do that times 2. That would have given us our initial investment of £89,000. So with that £89,000, we'll be able to go and get 2 properties that we'll be able to do up nicely. Forget about the added value here for a moment. I'm just talking about buying a property, just do it up nicely and rent it out. So that would be an initial investment of £39,000. So that would have been how much we've invested to get that property. So let's say now we've got the properties and we're going to rent them out. So if you're going to rent those properties out, properties like that, the rental income is likely to be about, let's say, £800 every single month. This is the rent the tenant pays you every single month. So obviously that would be your income for that month. Then obviously you have your interest payment. You've got your interest payment, and your interest payment, let's estimate that to be £250. This is the interest you pay for the 75% the bank would have lent you to buy the property for £100,000, which is on the £75,000. And then let's say then, because obviously you got to maintain the property, making sure it's running nicely, and for any repair and maintenance, let's say we put their running cost would be, let's say, about £200. Right? So, and that running cost obviously is an estimated figure. It could be less and it could be more, but obviously if you just renovate the property, that is likely to be less expense. So if you take the 250 and the £200 from the 800, we're making a net profit of £350. So £350 would be our monthly rental income. That would be £4,200. So £4,200, that's how much we would have made net profit from one individual property. So because now we've got two properties, we're going to times that by 2. That then gives us £8,400 per annum. So every year we would have made £8,400 with our investment properties. So that's our annual net profit. So because now we're comparing it with index funds, let's now assume that it is also for 20 years. You may be asking, why did I choose 20 years? The reason why I chose 20 years, because in most cases, 20 years is the life of a mortgage of a property you would have bought. So hence the reason why I'm looking at 20 years. So if you times that 8,400 by 20 years, for the two properties, it would have generated us £168,000. So £168,000 is what we would have made. Currently, if we're comparing this with the index funds, the index fund is still a better investment, isn't it? Because on the index funds, we are on 191,529.49 pence. So if we minus, we know the index funds gives us a return of £191,529. So if we minus that from 168,000, which is the return we are currently getting from our property investment as a rental income for the past 20 years, there's a difference of £23,529. Fantastic. So in this case, the index funds is still better than investing in property. But this is where everything changes. I see the index funds, how the value of it goes up by 7% every single year. The same thing applies to property as well. In the average, property price has gone up by 10 to 15% in the past 80 years. So what I like to do here is to compare it like for like. Let's say also we've bought these properties, we sat on them, we have not done any remortgage, we have not done anything else, we just sat on those properties, and then it goes up by 7% every single year for the next 20 years. Oh, sorry for interrupting this video. I just wanted to draw your attention to a guide I've just created. This guide is for you if you're looking to start and scale in property investment, and you've got questions that you want to ask in order to start your property investment. This guide is the ultimate guide to start and scale in property investment journey. I talk about the different type of investment strategies. I also discuss the 11 ways you can raise finance to make any property no money down deals, and the type of properties to buy in order to generate a serious return in your investment. And I'm giving this book away for completely free of charge, no string attached, nothing, absolutely free. Click the link on the description of this video to get your free guide now. We've only got a limited number of these copies available as well, so click the link to get your guide now. Let's get back to our video. So that £100,000 property, that we have here, if it would have gone up by 7%, exactly same amount of appreciation that the index funds would have gone, so that would have given us here 20 years. That would have been that same property we've bought for £100,000. That £100,000 property would have gone up by £386,970. So that's how much the property would have gone up in value, because obviously we've bought two properties. If we times that by 2, that would have been a total appreciation of £773,940. That's the appreciation those two properties would have gained in the next 20 years. As you know, when we bought those properties, the bank lent us £75,000 for each of the investment property, which then total up to £150,000. So if we put the 773,940 minus the £150,000, we would have got a net gain of £623,937. So now you can see, for renting the property, just renting it, we would have made £168,000. And from owning and holding the properties without doing any renovation, just holding it, literally holding it that way, and the property prices goes up by 7% every single year, would have also get a capital appreciation of £623,937. So if we were to then add those figures up, so those properties would have given us a net gain and rental income of £623,937 plus £168,000 rental income. That would have been a total of £791,937. So that would have been our net rental income and capital appreciation for the 20 years of investing in those properties. As we can see here, for properties, we have a net of £791,937. For index funds, we have a return of £191,529. As you can see, investing in properties gives us a net gain of £791,937 versus index funds of £191,529. So if you take that away, you're talking about £600,408 difference in the investment you make here. In essence, these are the returns you get from investing in properties versus investing in index funds. They both give you good return on investment, but properties outperform index funds. Okay, so let's now look at these two investment strategies. Let's look at properties versus funds. We know they both give us return on our investment and make our money work harder for us. So, but when you look at index funds, it gives you capital appreciation, right? You get that appreciation, that 7% return every single year. Okay, that is there, and your money is growing as you put in money in. Okay, and obviously it is better than savings. A lot more better than savings. That's a massive advantage there, and obviously it is less riskier compared to other form of investment strategies that I was looking at into, like cryptos, online business, and all that sort of thing. It gives you your steady growth during the investment process. So let's look at properties. For properties, the first benefit of investing in property is leverage. Leverage. So basically you can leverage. What does that even mean? So you'll be able to look at £100,000 property, and you don't need that £100,000 to buy that property, right? So you only need 25% of it, and then the bank will lend you the 75%. That's a massive leverage. Hence the reason why we're able to use the £89,000 to buy two investment properties. That's one benefit. And the second benefit of property is what we call cash flow. So the property generates you income every single month once you've rented it out and you set it up really, really nice. And then versus funds, when it comes to index funds, it does not give you monthly return. It does not give you monthly income. It's the reverse. You put in the money every single month in order to get that return in about 20 years time. So in essence, you're not making, but you are investing. In this case, you leverage the bank, you invest, and then you've got that monthly cash flow, which was the £168,000 in the next 20 years. So you make that money. And the other thing also, the other advantage of property is the capital appreciation. So as we discussed earlier on this video, when it comes to properties, it goes up every year in value as well. And in the past 8 years, it's been going up by 10 to 15%. And we did not even take 10%. We did not take 15%. And we factor in inflation and we only went for 7%. Again, it gives us serious capital appreciation. That was a beautiful thing to have, whilst you're also making additional income every single month. Okay. So, and obviously property is tangible. Okay, property is tangible. There's an advantage and disadvantage of this. Let me explain. Tangible meaning you can walk past it, you can drive past it, you see your properties, you can literally even visit it to see how your properties look like. You can get the feel to it. So it is there for you. But the disadvantage of that, if you want to sell that property now, it might take you a month, couple of months, or sometimes maybe 3 or 6 months for you to sell that property for you to be able to gain whatever profit you are likely to make. In the reverse, when it comes to investment funds, if you've been saving for 15, 20 years and you just decide you want to sell it, you can go in your account, press the buttons, and you can almost sell it instantly. Okay, but the disadvantage of doing that, you would have lost all the gain you would have made, because when you invest in the index fund, it takes momentum, it compounds itself. So the longer it stays, the more money you would have made. So in essence, you can get the money whenever you want it, but it is advisable for you to leave it in. So another advantage when it comes to property is that when it goes up in value, you don't have to wait for 20 years in order for you to realize the capital appreciation in that property. Because what you could do, as soon as it goes up in value, you can go and remortgage, pull some of that equity out. You can then use that equity to go and buy another property. Right? You can then use the same thing. After a couple of years, you do the same thing. So if you were to wait for 20 years and you remortgage your property, let's say for about maybe 5 times, you're likely to be able to have bought 5 more properties on top of the 2 properties you already have. So there's a massive leverage there. And whilst your property price goes up in value also, also hedge you against inflation. So the value of the property as it goes up is hedging you against inflation, meaning even inflation goes up, you're still going to be making your appreciation and your rental income as well. And when it comes to index funds, you would have to increase your monthly contribution in order to get more return on your investment. And again, when it comes to property, it does not work like that. You could actually do the reverse of what the index funds does, because index funds you have to add more in order to get more. Whereas once you've got your property here and you're renting it, you can increase your rent every single year. In essence, you get more money for the investment you would have made, and then ultimately gives you better return on your investment. I hope that is making sense. Another benefit of property investment is manipulation. So what does that even mean? So you could actually manipulate the value of the property. So how do you do that? Suppose you bought a 3-bedroom house and fast forward maybe to 5-6 years and you decide to say, look, I really want to extend this property. I want to make it bigger. You can then go extend it through the loft. You can extend it back. You can extend the side. You can enforce the value of the property that way. So you can manipulate the property to move from £100,000 property to 150, 180 or £200,000 subject to the amount of space you have within that property. So you can really manipulate it. When it comes to index funds, you can't do things like that. You can't really go and try to do something within the index fund to see if you can make money. No, it tracks the performance of companies. So you're not kind of in control there. You are kind of hoping that the top 100 companies or 250 companies are doing really well. That then gives you your 7% annual return on your investments. So these are the advantages and disadvantages of investing in property versus investing in index funds. So as you can see, both investment strategies gives us return on our investment. That then begs the question, what do I think? What is my opinion in these two investment strategies? So by the way, both investment strategies are amazing investment strategies, especially if you're looking for long-term return on your investment. You don't want to retire poor, or you don't want to really retire having to depend on pension, which we know it will not give you better return on your investment. So it's both good investment strategies. So these are the two investment strategies. Suppose you are in a situation where you want to invest in one of those. It is subjective. So in my opinion, basically is to look at where you are right now, because looking at the index funds, you don't need the £89,000 to start your investment. Right? You only need to start with £5,000, and then obviously you contribute £350 every single month to get that £191,000. Versus properties, in order for you to start, you need that £89,000. Though you don't need the whole £89,000 in one go, you can get the £45,000, you start going, and then when you get the over £49,000, you buy another property. That way then you're able to kind of grow your property investment portfolio. Suppose you've got these two options and you want to start your investment journey, and having the 89,000 will not be a problem. You can go and raise it. You can work with family and friends and raise that money, or perhaps you look at the £5,000 and you know you'll be able to contribute £350,000. Both investment strategies are very good investment strategies. These are the two most common investment strategies for long-term wealth generations. But here's the deal: if you were to choose one of them right now, wanting to expedite your investment journey, for me, I prefer properties. The reason why I prefer investing in property is that with properties, I can invest that money by leveraging the bank's money. And I also know in every 2-3 years, I can remortgage those properties and get more equity out, so I can go and buy more investment properties. Secondly, I have monthly recurring income. And third, I've got the capital appreciation, whereas I know in the next 20 years, my property prices would have gone up significantly. I would have able to double, triple those two properties and then get better return on my investment. And the beauty of it also, I can drive past it, I can walk past it, I can visit it, I can see, and I can also manipulate the properties. I can go and add value to them, increase the value significantly, so I can then pull back that money, go again, buy more properties. But one of the most important thing about investing in property also is that the inflation. You can borrow £75,000, buy that property, and you only have to pay the bank that £75,000. And the beauty of that, even though you're paying the interest on that £75,000, you've got someone paying it for you. Your tenant is the one that is paying your interest, because they're paying you the rent, and from that rent is what you're using to actually pay for the interest loan. And then obviously you're making that money every single month. So obviously seek a legal advice, financial advice before you make up your decision. But however, if I was to choose one of those strategies, I will choose properties. And that's what I chose when I started my investment journey, because I looked at index fund, brilliant way to invest, very, very good, low entry cost. You've got that contribution every single month, and then it then stacks up. But it kind of more suitable for maybe someone who's working, who's not making that much money at the moment until they start growing a bit of money. But I wanted to become wealthy, I wanted to become rich, and I wanted to own assets. I wanted to invest in something that I can control, something that I can leverage on, and something that can grow quickly, so I can get what I need to get from it, so I can go again and buy more houses. So then I decided to choose properties, and I was able to start from nothing to building a multi-million pound property investment portfolio. And now I use the proceeds I make from these investment properties to invest in index funds, which then becomes my kind of savings and another diversification. And now that is growing immensely, because now I've got this investment income coming in from my investment properties. So what I now do, I was able to put a higher initial investment for my index funds and a higher monthly contribution for my index funds as well. Looking at the next 20-40 years, you're talking about 15 to 20 million based on the investment rate I am going on at the moment. So in essence, you can start with property, start making money from that, and then you can then channel that money in your index funds, maybe hopefully with a bigger initial investment, and hopefully with a bigger initial investment, and you could also be able to increase your monthly contribution towards your index funds, and then hopefully in the next 20, 30, 40 years, that then becomes millions and millions and millions. So I really hope this short video has enlightened you on what sort of investments to choose if you were to invest among those two investment strategies. I hope this video has been helpful. If this video has been helpful, share it with friends or family. And if you want to learn how to manage and multiply income through investment properties, click on this video where I share how to manage and multiply income using your home equity. I look forward to seeing you on the next one. Thank you.